Hello and welcome to Earnings Echo. We put together the most important information about SoFi technologies. Today, we are doing a deep dive into a pretty massive market disconnect. I mean, SoFi is currently growing its top line at 41%, but the market is, pricing the stock like it's only going to grow at like 14.5%. Let's get right into the Q1 2026 numbers to see who's wrong here. Give me the hard facts.
Yeah, so the top line is accelerating rapidly. Q1 delivered a record adjusted net revenue of $1.1 billion.
Which is that 41% year-over-year jump, right?
Exactly. And adjusted EPS hit 12 cents. That actually secures their 10th consecutive profitable quarter.
Wow, 10 quarters. What about the forward guidance, though?
Well, looking ahead to the full year 2026, they're holding EPS guidance steady at 60 cents. And Q2 revenue is projected at roughly $1.115 billion.
Wait, hold on. If they just had their 10th profitable quarter and 41% revenue growth, why is management guiding for such massive margin compression in Q2? They're projecting a net income margin of just like 12 to 13%. Are they spending way too much to acquire users?
It's actually a deliberate front-loading of expenses. Management is aggressively accelerating marketing and, product investments in the first half of the year.
Right, to capture market share right now.
Yeah, exactly. They are setting up for stronger back half growth.
Okay, so they're spending heavily to capture users, but is it actually working? I mean, a major historical risk for SoFi is their over-reliance on lending. If they are just buying loan volume, that growth engine could, well, stall out pretty quickly.
The member acquisition metrics suggest the strategy is working broadly. They added a record 1.1 million new members in Q1.
That brings the total to what, almost 15 million?
14.7 million to be exact. At the same time, total deposits surged by $2.7 billion to reach over $40 billion.
Let's look at the segment breakdown, though. Is that top-line growth actually diversified away from lending?
It is. The financial services and tech platform segments combined for $504 million of the adjusted net revenue.
Oh, what?
Yeah, that represents a 24% year-over-year increase for those non-lending divisions. It proves that cash revenue isn't solely dependent on, just loan originations.
Let's unpack the lending side anyway, because there's this fascinating strategic tension in how they allocate capital. They balance the loan platform business, the LPB, against traditional balance sheet loans.
Right. The LPB pays the majority of cash up front, and it completely removes credit risk from SoFi's books.
Makes sense.
Conversely, balance sheet loans tie up capital and carry default risk, but they generate recurring net interest income. That was $690 million in cash this quarter alone. Management uses the LPB specifically to offload volume that falls outside their current risk parameters.
I mean, think of the loan platform business like flipping a house. You get instant cash, free up your capital immediately, and pass the rest to the buyer. Balance sheet loans are like keeping that house to rent it out. You get recurring monthly income, but your money is tied up, and you hold the risk if the tenant defaults.
That is an exact parallel to their capital allocation strategy.
Shifting to the earnings call, what stood out regarding the macroeconomic baseline? Because I know management confirmed they are modeling for zero Fed rate cuts in 2026.
The tone was exceptionally confident despite that zero rate cut assumption. They actually highlighted a Rule of 40 score of 72.
Wait, 72. For context for you listening, the benchmark for a healthy software company is 40. SoFi is nearly doubling that.
Yeah, it proves they aren't just burning cash to grow. They are driving highly profitable growth regardless of the macro environment.
Which brings us to the valuation. We ran a reverse equity DCF model. Because SoFi operates as a bank, debt and deposits are core to the model, so we use an equity DCF rather than enterprise value, using net income as a proxy.
Right.
If you aren't familiar with the reverse DCF, the mechanism is simple. Instead of guessing future cash flows to find today's fair stock price, a reverse DCF uses today's stock price to work backward. It tells us exactly what growth the market is expecting right now. Walk us through the math.
Sure. So at the current $16.60 share price, applying a 12% cost of equity, the reverse DCF indicates the market is pricing in exactly 14.5% annual net income growth over the next 10 years.
And this is where the disconnect is glaring. You need to weigh that 14.5% embedded market expectation against the hard facts. SoFi is currently executing 41% top-line growth.
And guiding for $825 million in full-year net income.
Exactly. The market is pricing in a massive slowdown that the quarterly numbers simply do not reflect.
What we are seeing is the core long-term investment thesis materializing. SoFi is successfully transitioning from a pure lending platform into a diversified everything app.
Right, they are leveraging that financial services productivity loop to cross-sell products to their massive user base.
Precisely. By getting a user in the door with a high-yield checking account, they drastically lower their customer acquisition cost for when that same user eventually needs a mortgage or a personal loan. The compounding effect of that loop lowers their overall risk profile over time while scaling profitability.
So here is the final echo to monitor. Track how SoFi's accelerating deposit growth and their zero rate cut macro positioning affect net interest margins in the upcoming quarters. Consider this, as SoFi pushes aggressively into their new big business banking platform and relaunches crypto services, how will exposure to these volatile sectors test the carefully managed credit risk profile that got them to 10 consecutive quarters of profitability?
It's definitely the key tension to watch going forward.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.